Picture this. You walk into a dealership on a Saturday morning. The bikes are spotless. The lot is full. But inside, nothing. No buyers, no test rides, just motorcycles that should have sold months ago, still wearing price tags. And here's what nobody's talking about. Nearly 2 million motorcycles are stacked in the system right now, and they're about to flood the used market. The question isn't whether it's happening. The question is how it reached this point and why almost no one saw it coming. That quiet showroom, it is not an isolated scene. It is a measurable pattern. Across the United States right now, close to 2 million motorcycles are sitting unsold. Not reserved, not financed, not rolling out the door, just parked, listed, waiting. That number changes everything. This is not one dealer misreading the market. It is not one manufacturer stumbling through a bad quarter. Inventory has been stacking month after month, season after season. New shipments arrive while last year's models still occupy floor space. Pre-owned listings multiply faster than they clear, and this is happening everywhere. From large metro dealerships in places like Dallas and Phoenix to small-town power sports stores in the Midwest. From online marketplaces to wholesale auction yards, the signals are consistent. Listings linger past 60, 90, even 120 days. Prices edge downward. Trade-in offers shrink. Repossessed motorcycles quietly re-enter circulation. Nothing exploded overnight. It accumulated. And if you've already felt that pause, fewer buyers, softer prices, longer wait times, hit the like button, drop a quick hype, and subscribe. That's exactly what keeps us committed to bringing real market breakdowns instead of surface-level dealer talk. For years, riders believed the used market would always absorb the excess. That spring demand would reset the board. That motorcycles naturally held value. But when supply climbs into the millions, seasonality loses its power. And once you understand that scale, the next question becomes unavoidable. Why is every major brand being dragged into the same undertow? For years, it was convenient to point the finger at one logo. Maybe Harley-Davidson was losing older riders. Maybe sport bike demand had cooled off. Maybe one manufacturer simply overplayed its hand. That theory doesn't survive the data anymore. Harley-Davidson has reported shrinking retail numbers. Honda has trimmed shipments in several key categories. Yamaha, Kawasaki, KTM. Listen to their earnings calls and you hear the same language. Slower turnover, rising incentives, production adjustments, different machines, different price brackets, identical trajectory. Cruisers are not insulated. Sport models are not spared. Adventure bikes, full-dress tours, even entry-level commuters. All moving with less urgency. These are companies that endured recessions, fuel price spikes, regulatory changes, and supply chain breakdowns. They adapted, they recalibrated, they survived. So when every major brand tightens forecasts at the same time, this is not a design problem. It is not a marketing problem. It is momentum fading across the entire category. Dealers see it first. Units sitting beyond 90 days, incentives replacing full sticker deals, trade-in values adjusted downward to control exposure. Even the most respected name on a fuel tank is no longer shielding resale. Let me ask you this. Have you noticed this where you live? Bigger discounts, bikes sitting longer than they should? Share your experience in the comments because real-world rider data often shows the trend long before official reports do. This is not about popularity. It is about movement slowing everywhere. And when movement stalls across every manufacturer at once, the next phase becomes unavoidable, because this is where the strain turns mechanical. Most motorcycles in America are not purchased with cash, they are financed. Fixed monthly payments, terms stretching 4, 5, sometimes 6 years, longer than many riders planned to keep the machine. When prices were climbing and demand felt endless, that structure appeared safe. If someone needed to exit, they could sell. If finances tightened, strong resale values covered the balance. That only works when values rise. When used prices begin to slide but loan balances remain the same, the equation breaks. A payment gets missed, then another. Notices are mailed. Deadlines pass. Eventually, the lender reclaims the asset. And lenders are not enthusiasts. They are not waiting for peak riding season. They are not polishing chrome. Their objective is recovery. Once a motorcycle is repossessed, it moves fast, straight to auction lanes, then into wholesale channels at whatever clears it quickly. Now multiply that process by thousands nationwide. Motorcycles that were meant to be paid down gradually are suddenly dumped back into circulation. not by choice but by circumstance. Each one resets expectations. Auction prices slip. Dealers adjust trade-in offers. Private sellers feel the squeeze. Supply increases. Values recalibrate downward. And that brings us to the next lesson. The deeper forces most riders never connect to this routine unraveling. It would be convenient to pin this on inflation, rising interest rates, or a shaky year in the broader economy. If that were the full story, the pattern would look familiar. Sales would dip sharply, then rebound. Buyers would hesitate briefly, then return once conditions improved. That is not what is unfolding. This was constructed gradually. Over the past decade, motorcycles drifted from accessible recreation toward premium indulgence. Sticker prices climbed. Financing terms stretched longer. Monthly payments that once felt excessive became standard. The entry point moved upward, quietly narrowing the funnel of new riders. At the same time, the generation that powered the industry's strongest years began aging out. Many are riding fewer miles, downsizing to lighter machines, or stepping away entirely. Meanwhile, younger adults face different priorities: urban housing, flexible work, student debt, and a culture less anchored to ownership. The ritual shifted. Fewer impulse upgrades, longer ownership cycles, more caution around financing, higher insurance premiums, limited storage space, competing demands on disposable income. Manufacturers kept producing based on yesterday's velocity. Dealers stocked showrooms expecting the usual seasonal lift. Lenders structured loans assuming steady appreciation. Demand thinned instead. This is not a temporary contraction. It is a structural reset, and structural resets always redistribute pain. And if any of this feels familiar, the rising costs, stretched financing, or seeing fewer riders on the road, hit the like button, drop your experience in the comments, and subscribe to the channel. That's how we keep breaking down these market shifts for riders like you, so you never miss a move in the industry. And as demand thins, the pressure doesn't stop with riders. Dealerships are next in line. The inventory they once relied on for seasonal lift now sits idle, carrying costs piling up. In the next chapter, we'll see exactly how this structural shift is squeezing the very businesses that once fueled the motorcycle market. Dealerships are the pressure point in this entire system. They stand between manufacturers pushing shipments, lenders financing inventory, and riders who may or may not commit. When sales velocity weakens, that tension settles squarely on their balance sheets. A dealer cannot simply wait for spring. Most new motorcycles arrive under floor plan financing. That means interest accrues on every unit sitting on the showroom floor. Whether the doors are busy or silent, the meter runs. Insurance premiums do not pause. Rent is due. Technicians expect paychecks. Lights stay on. Advertising bills arrive. Even inactivity carries expense. When motorcycles sit for 90, 120, even 180 days, the math becomes uncomfortable. Cash flow tightens. Margin shrinks. Decisions shift from expansion to containment. Discount early to free up capital. Hold firm and hope demand returns. Reduce staff. Delay future orders. None of these choices signal confidence. They signal caution. Meanwhile, manufacturers still operate on production schedules. Incentive programs may offer relief, but they often require additional volume commitments. Take more units to unlock rebates, or scale back and risk losing allocation priority. Trade-ins add another layer of risk. If used values are unstable, every appraisal becomes a gamble. Offer too aggressively and absorb the loss later. Offer too conservatively and lose the sale entirely. The culture inside the dealership changes. Less celebration, more calculation, fewer events, more inventory management meetings, no incompetence, no panic, just a tightening system responding to slower movement. And while dealerships absorb structural strain, the financial consequences do not stop there. The real impact rides all the way home with the owners themselves. In the next chapter, we'll see exactly how this market squeeze hits riders' wallets, their bikes, and the decisions they face every day. For riders, this collapse doesn't announce itself on the news. It sneaks in through a number that feels wrong, a trade-in quote that forces a second look, a listing that racks up views but never conversations, a payoff amount that refuses to line up with reality. On a balance sheet, it's depreciation. In real life, it feels like betrayal, because motorcycles aren't paper assets. They're chapters of your life. Early mornings before work, long rides that cleared your head, the bike you waited for, Planned around, justified because you believed you were making a smart decision, not an impulsive one. You didn't chase hype. You didn't overextend. You did the math. And now the math has changed. Being underwater alters everything. You hold on to a bike longer than intended, not out of love, but because leaving means locking in a loss. The next upgrade fades into the background. Accessories feel irresponsible instead of exciting. The future you imagined quietly shrinks. It reshapes identity without asking permission. For many riders, there's pride in ownership, not just in riding, but in knowing your machine holds its value. When that disappears, it doesn't only hit your wallet. It shakes the belief that this passion was balanced, rational, justified. For some, the pressure runs deeper. Late payments carry a silence people don't talk about. Repossession carries a mark that lingers, even when circumstances shift through no fault of your own. Rising interest rates, falling values, a market that moved while you were standing still. These aren't careless buyers paying the price. They're ordinary riders who followed the rules. Stable income, manageable payment, took care of the bike, did everything right, and still the ground gave way. That's what makes this moment dangerous. Once the loss becomes personal, decisions stop being theoretical, because the next choice isn't about motorcycles anymore, it's about timing, and whether waiting one move too long turns an uncomfortable situation into one you can't escape. And that brings us to the question every rider is about to face next. So the question everyone asks eventually rises to the surface. Do you buy now or do you wait? The answer depends entirely on where you're standing. If you're a buyer with cash, stable income, and no plan to flip the bike anytime soon, this market finally tilts in your direction. Inventory is thick. Sellers are cautious. Negotiation is no longer uncomfortable. It's built into the conversation. Time, for once, is working for you, but only if you use it correctly. If you've been here a while, you already know what Iron Pulse is about. We drop the essentials, old school, rider-made style, the cap, for long miles and windy days, the T, for the garage, the ride, and everywhere in between, the mug, for early starts and late nights planning the next run. No hype, just the mark. 20% off right now. Link in the description down below. Lower prices mean nothing if financing cancels the advantage. Elevated interest rates can quietly turn a great deal into a long-term burden. Stretching a payment to make the numbers work is the fastest way to give back every dollar you saved on the sticker. In a softening market, flexibility is leverage, and leverage disappears the moment you overcommit. For sellers, the reality shifts again. Waiting feels reasonable. Spring riding season, better weather, renewed demand. That logic used to work. But when inventory keeps stacking and more bikes enter the pipeline, delay often means competing against an even larger wave later. The belief that prices naturally bounce back can be dangerous during a structural reset. This isn't about beating the market, it's about placement. Buyers win with restraint and patience. Sellers survive with realism and timing. Both sides are being forced to unlearn old assumptions, that motorcycles always hold value, that seasonal demand solves everything, that tomorrow automatically corrects today. The biggest change isn't financial, it's psychological. In rising markets, speed creates advantage. In falling or recalibrating ones, strategy decides who gets hurt least. No one rings a bell at the bottom. Markets don't announce turning points. And while individual riders weigh their next move, a much larger decision is being made elsewhere. Because the next phase doesn't start in the showroom, it starts at the manufacturer level, where the future shape of motorcycling is being quietly rewritten. If this deep dive into how manufacturers are recalibrating made you think differently about the bikes you ride or the ones you might buy next, click that like button. And if you want to support our channel even more, get early access to the newest videos tracking this market and be part of our tribe. Become a member. What happens at the top doesn't just stay there. Your insights, questions, and experience help everyone understand what's coming next. At the very top of the industry, this moment doesn't look chaotic. It looks controlled, quiet, calculated. Conference rooms instead of press releases. Forecasts adjusted behind closed doors. Production numbers pulled back line by line. Model ranges reviewed with a harder lens. Incentive programs reworked to slow the bleeding because the old formula depended on motion. Build the bikes, ship them out, finance the buyer, do it again. That system only works when demand keeps pace, when new riders replace aging ones, when used inventory cycles cleanly through trade, ins and upgrades without clogging the pipeline. But once momentum slows, everything changes. When repossessions swell the secondary market, volume turns into exposure. Incentives stop moving metal and start eroding margins. Units that once represented growth become liabilities sitting on balance sheets. Moves that used to signal confidence now carry consequences. Premium pricing raises resistance. Long financing terms amplify default risk. Aggressive expansion magnifies overhang. So manufacturers are being forced back to first principles. Do you cut production to preserve brand value, even if it hurts short-term revenue? Do you lower prices and risk resetting expectations permanently? Do you protect a premium identity or widen the gate with more attainable machines? Do you invest in new rider pipelines, training programs, community access, smaller displacement platforms to rebuild demand from the ground up? This is where reality draws a line. Some companies will treat this as a temporary slowdown and wait for conditions to normalize. Others will recognize something deeper, a demographic shift, a cultural rebalancing, a financial ceiling, and redesign around it. Because this doesn't behave like a pause. It behaves like a recalibration, and recalibrations punish rigidity. The brands that make it through won't necessarily be the loudest, the most historic, or the most visible. They'll be the ones willing to align production with real demand, support dealer survival, and redefine what motorcycling means in modern American life. When the assumptions at the top start to crack, it tells you this isn't about quarterly earnings. It's about the direction of the entire industry. And that leads directly to the question every rider, buyer, and dealer should be asking: what does this really add up to? What we're witnessing isn't a temporary slump, it's a hinge moment. For years, the industry assumed demand would always refill the pipeline, that higher prices meant strength, and that the used market would quietly absorb the excess. That belief has worn thin. Nearly 2 million unsold motorcycles now expose a deeper mismatch between production, financing, and real participation. This isn't an ending, it's a correction. The industry isn't disappearing, it's being forced to decide what it becomes next. 2 million bikes without buyers, a used market reset, a culture quietly evolving. What comes after this will look different, leaner, smarter, and possibly healthier for riders, dealers, and manufacturers alike. If this video changed how you see the used motorcycle market, don't stop here. Click the next video to continue the road trip and see where the real opportunities and risks are emerging. Join the tribe by subscribing. And if you want to support the channel and get early access to what we're tracking next, becoming a member makes a real difference. And before you head out, don't forget to like this video. It tells the algorithm this conversation actually matters.